Welcome to the Simplified Dentistry podcast. Join us as we discuss clinical, operational, and financial aspects of your practice, help you enjoy life, and dare to simplify dentistry.
Hello, and welcome to the Simplified Dentistry podcast. I'm Dr. Mustafa Shakan, along with my co-host, Dr. Richard Offit. We'd like to introduce today's guest, Jonathan White, CPA. Jonathan W. White is the founder and president of Jonathan W. White CPA, a dental-specific CPA firm that services 300 practices across all specialties. The firm offers comprehensive services including tax compliance, financial planning, accounting, and retirement services. Jonathan, thank you for being with us today.
Thank you, and I appreciate both of you for having me on. Hopefully this will be very informative for your listeners, and especially as this is the time of year. We're actually filming this right after tax season ends, so your CPAs are probably worn out, and they're ready for your year-end questions to get started and really start focusing on what is important for the end of 24.
So, Jonathan, what should our listeners be thinking about going into the end of the year, and what kind of plans should they be making for Q4 and looking at what they're going to do for next year? Or is it too late to make changes for Q4?
Yeah, so very important right now to really start looking at Q4. Not too late. There are some things that potentially you could have missed, but very few. A lot of the planning, unfortunately, happens in Q1 of 25 when someone brings their information into their accountant who they've not looked at all year and then get these big surprises, and then your planning is very limited. So as you head into fourth quarter, the biggest thing that I see as we onboard new clients, especially towards year end looking for planning, is they don't have good underlying numbers. And so the number one thing for your CPA to truly be able to plan you is the underlying numbers have to be solid, right? Because if they're running projections and P&Ls off of numbers that aren't really vetted, I've seen a lot of mistakes there. So getting good quality numbers to be able to, whether that accountant's the one vetting those numbers or you're feeding them to them, is kind of the bedrock. And then once you do that, is you really need to start working through a projection with that CPA. And usually it involves kind of them pulling together all your information and kind of sitting down and walking through some of the key items we're going to talk about. I always say there's a toolbox for almost every dentist. There's probably 8 or 9 things almost every dentist in the country should be doing at some form in their career. But then there's some that could be specific to you, or maybe we're going a little heavier this year than not. So all of those things you really want to sit down and get a projection in fourth quarter. Fourth quarter is definitely not too late. It's better if you've looked at it mid-year, because if you're way up in your practice, and that's one of the things we do, and when we're looking at financials, we don't really work with a practice unless we are actually involved in your accounting. And that is one of the biggest reasons is I can see in June that you're up 30% and we need to start making some changes. So definitely not too late, but now is the time.
So Jonathan, what an amazing introduction. Thank you, Dr. Shakan. I probably should leave the room, but let's get kind of granular on what information do you want from the dentist? I mean, what do you want? I mean, is back of the envelope okay? Or do you need very accurate, well-prepared, and well-documented data?
Yeah, if you want good projections that are actually going to hold up, you're going to need well-documented data. Back of the envelope will get you close, but it's not going to get you to where I think you want to be. Kind of walk you through kind of our process. So we're usually taking your financials and forecasting those out for the remainder of the year. We're looking through all your payroll to make sure that you've maxed your 401k and any adjustments you should make there. We're looking at any family on payroll, anyone that we should be adjusting there. So back of the envelope, and a lot of clients do that. You know, they say, hey, I feel like I'm up. Unfortunately, managed by the bank account. Right. And ultimately, that's not the way to manage a business and get good projections. So you do need a much more granular detail. But if you're keeping your own books, then your CPA probably needs to work through those books and make sure that adjustments are made. If the CPA is keeping the books, which is usually the best method, then if they're keeping up good, accurate books, then that should definitely funnel your projections.
Do you find that there are actually docs out there that are keeping their own books, keeping their own P&Ls, and then kind of coming to fourth quarter and being like, all right, I need my CPA to straighten all this out? Or do you see most people actually using a dental-specific CPA who's running their P&Ls and things like that?
I would say the majority of clients that at least we pick up are using a CPA, not always dental-specific, that are involved in their books on a month-to-month basis. We once in a while we just picked up a really large practice where the doc was running their own books, and the CPA was making adjustments at year end, and literally we're going to have 3 years of amendments. So that's always the worst method, because there's a handful of doctors that are know accounting backwards and forwards, and their books are going to be right. But y'all know as well as I do that just doesn't happen that often. And so sometimes too, a CPA trying to unwind all that in a quick projection, also the things get missed. So majority we see at least a CPA involved. Typically, a dental specific CPA is best, but our firm, we don't work with clients where just bring us our books. So once you transition to us, we're doing that method where we're in your books on a consistent basis.
Yeah, Jonathan is my CPA and has been my CPA since he started. And I can tell you, the last thing you want is me to be doing my own books. And you should see what I hand Jonathan. I hand Jonathan a stack of stuff, and literally
Shoebox.
it's
Shoebox.
not quite a shoebox. It can be scanned and sent to him.
Yeah.
But it literally, like how I categorize things, it's on a piece of paper, basically, and it's like, this is what I think this is. This is what I think it is. Jonathan humors me by taking all of that and all of my banking information and consolidates it and categorizes it correctly. But, to your point, dentists doing it themselves can only hurt themselves, I think. I think you will miss so many things. You open yourself up for audits. There's all kinds of problems there. You touched on one thing with being a dental-specific CPA. You hear a lot of guys who will be using, this CPA is really great. I like him. He does my buddy's books, and my buddy is a contractor, or, they have a chain of grocery stores or things like that. And, I would think that there are lots of things that get missed when you're not using somebody who actually understands your business and understands what the ramifications are of the tax code on dentistry specifically. Why use a dental specific CPA?
Yeah, that's a good question. And the answer is I'm a dental specific CPA. So of course you should always use a dental specific CPA. But no, I think it's more than that. And I kind of thought about that question because we had talked about it the other day. And I stepped back and I said, well, really that CPA is making a commitment to your industry. So I think first and foremost, that firm, that person has kind of said, hey, I'm going to spend time and learn your industry. So to me, that person is probably a little more committed to working directly and understanding what you're doing. But second, as you mentioned, it is impossible to be a jack of all trades. And when I came out of school, my first job was working at a firm that we audited banks and credit unions. And I learned from that senior partner, he would only audit $1 billion or more credit unions, and built a massive business on that. He actually wrote the rules for credit unions at the technical level for the AICPA because that's all he ever kind of worked in. And really, I learned from him was, no matter what that lane is, pick it and become really good in it. And we're seeing more and more of that in the CPA world, not just in dental, but in a lot of kind of niching down. And I think using a dental specific CPA, they're going to know your business, right? So what I hate is the year-end, and I'm probably going to make some Patterson guys mad, but the year-end guys who come in and say, hey, I can get $179 on this, right? If I buy this $100,000 piece of equipment. Well, you lose 60 cents on the dollar, right, to save 40 cents for a piece of equipment that may not make your business better. So the first questions I always ask is, will this make the customer experience better? Will it enhance patient care? And can we make money on it? And if the answer is no to those items, then maybe we should pay the tax and take 60 cents and invest in something else. So I think having that dental specific CPA who understands your practice management system, I'll tell you a story here recently. We picked up a practice and we looked at the returns, and we obviously knew that the revenue was wrong. And simply because when we pulled the practice management reports, net collections they were so far off, and they had made deposits into the business that were not actual receipts, and they just end up as paying tax on it. And so we as dental specific CPAs, and I can't speak for all of us, but generally you're going to find they're involved in your practice management. They're going to get your practice management report and look at your doctor days. Dr. Khan mentioned that, he is our client, so he can kind of give you the experience of, we have a dashboard, and that dashboard lays out the production per doctor day and the number of doctor days you worked and hygiene production and all those analytics. are not going to replace a practice management consultant necessarily for you, but it identifies trends and problems within your practice to at least throws up that alert red flag. Where if you just have a general CPA who is sending you QuickBooks reports, you're going to miss all of that.
Tell me this, when you work with dental specific clients, what is the question that you like to get? Doc calls you up and says, Jonathan, and then he asks you a question. What is that question?
Yes. That is any question involving them spending a lot of money. And that can be investments, right?
Yeah.
Or before they sell a piece of real estate or before they bring on a partner. So a lot of times, and I think CPAs in every industry will tell you this is we get the question, or actually we get the result and ask how to fix it, right? Oh, I just sold this piece of property and I don't want to pay tax on it. What should I do? Well, you could have done a 1031, but we didn't talk about this 3 months prior. So I think any question that involves a significant financial transaction, if you're involved with your CPA, whether it's a practice or your personal side, you should be having that conversation. Probably with a financial advisor as well, especially if it's big money. But from the strictly kind of accounting and tax standpoint, anything that is going to have a significance, especially on the tax side, we'd prefer to have that question first. On the practice management side, it's really looking at trying to change your practice. A lot of times, the thing that can be most impactful is dropping insurance. And so a lot of clients will come to us and say, should we drop insurance? Well, the short is we'd like to. We'd like to drop all insurance, but that's not always practical. And so being able to guide them through either scaling down insurance or working with someone who's good at helping negotiating PPOs, that's something that question we would like to have more often. And really think about their business, because that can add so much to the top line with actually seeing less patients.
They said ADA just released something that came out, I think yesterday I saw 36% of practitioners surveyed dropped at least one network last year. And 55% of practitioners reported that insurance reimbursement was the biggest stress in their practice, which is crazy to me because the biggest stress in my practice is hygienist. But I think that
and the employment thereof, right?
correct.
Yeah, that's right.
I love hygienists. Don't take this the wrong way.
Right.
Yeah.
It's just the gymnastics of being able to staff that role has become difficult, and it's become even more difficult since COVID. So, what are your thoughts there? I mean, what's your idea on how should the hygiene work in your practice in terms of overhead and responsibility to the practice?
Like, are you seeing more? We were talking to Kane Waters guys earlier today, and they were saying staffing should be 25%. And I was like, well, how can you say that with what hygiene is doing right now and what staffing costs are? Are you adjusting for that, or are you saying, hey, Doc, you got to pass the fees on, or you got to raise your production, or what are you saying?
Yeah. So key there. Well, if they can see 25%, you must be in some rural area, because you're not really seeing that across the board right now, and hygiene being the key. So if you're in network with insurance and your reimbursement, let's say it's $100 for a pro fee, and that hygienist costs you $55 an hour and not $35 like she did pre-COVID, or he cost you pre-COVID, there's no way, unless you can pass that along to your patients. And if you're in network with that insurance, you're kind of stuck. So you're going to see staff cost increase. And that's what we've seen. Prior to COVID, you'd ideally like staff cost for hygienists to be about a third, right? So a third of their production that would be everything. So that's payroll, taxes, benefits. And now that number's creeping up. So if we just do back of the envelope numbers, is if a pro fee's $100, let's just use round numbers, and that hygienist costs us $50 all in, they're getting 50% of their production. Doctors don't get that.
Yeah.
So when you look at that perspective, it is a challenge, but hygiene, it is the blood of the practice, right? It's how you get your, appointments, you see your people, you get production from there. So it's required. The only way to be able to do that is if you're not in network and truly be able to raise and pass that fee along. But I don't know how much of that you can pass along before patients start pushing back. So I would think traditionally in a GP practice, we would see about 27% all in benefits and everything for staff costs. That's everyone. I'm seeing that number tick up a little bit, and a lot of that is in the hygiene. But even your assistants, they're not as inexpensive as they were, say, 3 or 4 years ago.
Sure. Going back to the dental specific CPA and the questions that they get, I can tell you, for one, I don't do anything without asking Jonathan. I don't buy a car for my kids. I don't refinance anything. I don't do anything without at least getting his input on the front end. A lot of times I don't like what he says, but I do listen to him. Yeah.
And that's the key, right? Is if I tell you what you want to hear all the time, I'm probably not a good advisor to you.
Yeah.
And I think, you talk about what kind of person are you looking to work with or firm you're looking to work with, is you don't want a yes man, right? Any great leader doesn't want to be surrounded by yes men. And so, good, bad, or indifferent, I'm always going to tell people what I think. I always tell people I'm an acquired taste, kind of like a fine wine. Some people
Sure.
love me, some people don't. But I'm going to tell you what I think. And at the end of the day, I think that's very important because, we get all kind of harebrained ideas that come in the door, from clients. And so being able to tell them, hey, it's not a great idea. If you do it, at least we've warned you, is very important.
So kind of coming back to where we started this, Q4, what are you advising? So let's say you've been working with somebody from Q1, you did all the planning and things like that. But let's say there are things that you guys haven't talked about. What are you advising guys to make sure they're doing, whether it's retirement or different rules or other things, or how they're treating family? What would you advise somebody right now?
Yeah, we had briefly touched on that earlier. Is there's kind of that toolbox that I think most dentists should be using. And the number one thing, the largest thing you can do to defer tax and save is the retirement plan. And a well-designed retirement plan for either 401k or if you got a souped-up retirement plan, a cash balance, is usually, for a doctor over 50, the best way that they can put away money and save taxes up front. There's cost to run those plans, but they more than pay for themselves if you're doing that correctly. That's usually your biggest, I want to call hammer, right? So someone who's got a very productive practice, they're in their early to mid 50s, running a cash balance plan, they may be able to put a couple $100,000 a year into that plan where they're getting the predominant benefit from that. And then there's a bunch of bread and butter items like HSAs. So if you're HSA eligible, it's the only triple net tax benefit out there. It goes in tax-free, it comes out tax-free, and it earns tax-free. So those kinds of things, which are small, definitely employing family. And family, that's key in your retirement plan as well.
How would you, so talk to us about that. How do you employ family? Do you just all of a sudden say, I think my wife deserves $250,000 a year?
No. And so that's that part. It actually, let's talk about even doctor comp, right? So most doctors run an S corporation, which means they need to have what they call reasonable compensation. So you can't pay yourself $30,000 and take all dividends. You got to pay reasonable. And when you're a retirement plan, there's something called your max retirement plan compensation. That number is indexed to inflation, so it goes up every year. But that number is, I think, 345 for 2044 or 2024. So what that means is if you pay $345,000, when your TPA or your administrator is running those analysis, that is the max amount of salary that can be included in the computation. So if you paid yourself $400,000, it doesn't make your retirement plan test any better. If you pay yourself less than that, then you potentially, your testing could cause you to pay staff more. So there is an optimal doctor retirement number. And then staff, and when we say staff, we're talking about your wife or your kids or your spouse on payroll. That should be reasonable to what they're doing, right? So kids are running your social media. Kids are, helping around the office and stuff. So you can't pay them $70,000 because that'd be considered unreasonable and hard to justify. So those salaries there, you should work with your CPA and kind of come up with what the duties are and then set a salary from there. At minimum, you'd like to have duties, especially for your spouse, to at least have them max defer into the 401k plan. And then from there, if they're doing additional duties, because we actually have seen spouses who made $200,000 because they were helping essentially the CEO of a very large practice, and it made sense to pay her that much based upon the retirement plan and her duties. But that's uncommon. Sometimes, usually, you're in that $30,000 to $50,000 range.
So I hear a couple of different things. Yeah, sometimes I'll hear people say, "Well, what you do is you pay your wife. Obviously, helps and works in your practice, but you pay her just enough to max out her retirement, and there's just a little bit of peripheral cash." Then I'll hear some people say, well, you do that, but you also pay her more compensation to justify that, maybe she's a front office administrator. Do you really want to do that? Or is it a benefit, a hindrance from a tax perspective to do that? And then kind of on kids, I'm going to ask you a bunch of questions, but on kids, is there a magic number? You say, okay, well, my kid's 16, so 16, they should get, their age times this, 18, their age times this. Is there a formula you look at, or or where do you come up with those numbers?
Yeah, so there's not necessarily a formula. There are a bunch of rules of thumb you will hear out there in the community, and some CPAs will throw those out there. If they're sitting across from an auditor, and I used to audit banks for a living, so I kind of know that other side of the table, you've got to be able to justify that number, and a rule of thumb wouldn't be the justification. So you do want to be able to log those duties and have a job description that is commensurate with what you're paying them. But there are some kind of strike or thresholds you want to hit. Like if you want to fund their Roth IRA, then they need to make at least $6,000 or $7,000 to be able to fund their Roth IRA. And if you want to max 401k, then you do want to hit that, say, $30,000 threshold for a spouse to max that. Anything above that, now if you're paying them for their duties, maybe helps with Social Security and Medicare in the future, but you are paying additional Social Security and Medicare tax on that there's not really an additional benefit because if you're both married, that income ends up on your same tax return. So you're not really saving any taxes by going above that threshold. There could be other considerations too outside of just strictly tax to pay more. But from that perspective, I don't think paying them more necessarily accomplishes a big tax goal.
So, Jonathan, a million years ago when you had to stuff statements and put stamps on the outside of envelopes, my 5-year-old and 7-year-old did that for my practices, and many times the stamps were in the wrong corner, and the patients would bring them in and say, "Doc, did you really do this?" And I'd go, "No, but pretty good for a 5-year-old, right?" So talk a little bit about that. I mean, what are these age thresholds for employing children, and that would be my first question. And the next question is dealing with automobiles within the business.
Oh yeah, and that's another big one. So they're the kind of I guess best benchmark for IRS tax cases for kids is around 7 years old. So if you've got a kid younger than 7 years old, there's really not a tax case out there that kind of supported that. There is one for 7, but you're kind of hitting the nail on the head with duties. Is you don't really stamp. Now that 5-year-old would need to be able to run a social media channel, right?
Right.
So it does get a little more challenging.
I mean, we did it. No, Jonathan, we did it on the playroom floor. I mean, there was a stack of envelopes and stickers on the outside. And,
That's right.
I mean, first it was printed on a dot matrix printer. So it was quite a while ago. But I'm sorry. Go ahead.
No. You're exactly right. So duties are important to kind of be able to support that. So at least as they get older, being able to have social media channels, and they're probably more adept at working in social media than we ever would think of doing that. So that helps. And then, as far as being able to actually have the kids in the practice, it is really important to support those. Sorry, what was your second part of that question?
Second question was dealing with automobiles.
Oh, yes, automobiles. So
not airplanes and boats, but just automobiles.
I don't know how you deal with airplanes. I see guys dealing with airplanes, and I can't figure that one out.
If you have a lot of money to lose, that's my philosophy on airplanes, right? If you got a lot of cash to burn, go for it.
Yeah.
Airplanes, 30 seconds on that, right? You're not tracking miles, you're tracking a number of hours in the air, and you better have some personal use because it's hard to justify 100% personal use or business use on that. We actually have clients who have airplanes. It's not common, but it's not uncommon either. Definitely more risky as far as like being on a practice to have an airplane. But second is the cars. So cars are considered listed property, and listed property brings a much larger documentation requirement. You really should have a mileage log, and you should track what is business and personal. And if you're not above 50% business, then you really shouldn't have a car on your business. So it is, if you look at a lot of one doctor practices, if they were to really try to track their miles, it can be a challenge to get enough business miles. But remember, anytime you go to the post office and CE or any miles you drive that car that's for the business outside of commuting back and forth to your office, those all get you to the car on the practice. But everyone wants to write off the car on the practice, right? I mean, that's the quintessential tax deduction that everybody can do. And so typically what we've done in the past is, you're going to take your business percentage, and then you're going to use your business percentage of whatever the gas oil maintenance. You pay all that through the business. You just want to be cognizant if you are audited. And in the last 10 years, we've had audits, but honestly, they really haven't looked at cars much, but it was something that was hot and heavy looked at, say, 10 years ago. If you don't have some kind of an audit log, then it could get overturned. So I always say cars, for your average dental, what I'd call bread and butter return, cars is probably the riskiest thing they have on there, because not necessarily they don't drive the business miles, there's just no tracking of what they're really doing.
So note to our listeners: take the boat out of the practice.
That's right.
Yeah.
Okay,
Yeah.
and
And
to simplify the red flag rule, right?
Yeah, if you've got a boat on your practice, then that's a whole different discussion, right? Well, and believe it or not, I've seen someone with a boat on their practice. I still don't think they could justify it, but the practice was very close to a lake, and they said that they shuttled passengers from one side of the lake to the other. So I have seen some
Passengers or patients?
both, right?
There you go.
But I still think that was a stretch, but we didn't put it on there. It came to us in that, but you do see some wild stuff. But cars, and here's the other part of cars. Sometimes we'll get a practice with 5 cars on it. Well, you got one doctor, right? Even if you want to stretch and put a car on for the wife, which, once again, you got to have duties and miles and hit all the thresholds to be able to do that. You start getting 3, 4, 5 cars. To me, that you get outside the bounds there. And so from our standpoint, we always try to, train clients on what the right thing is and how to do it. And even when I was an auditor, I was like, the goal isn't to get it past me, right? If you got to sit down with the IRS, you got to get it past them, right?
Sure.
And a lot of times we'll pick up a set of books and the clients felt like, we tucked something in there and he didn't see it. I'm like, even if you got it past me and I didn't see it, you didn't necessarily win the lottery, right?
Sure.
Right. It's kind of like the rule of thumb that I think I even told Dr. Chacon this one time, is that if your friends don't believe it, the IRS is never going to believe it,
Yeah.
right? If you're sitting with your friends and you lay out a plan and they go, boy, that doesn't sound right, maybe you should not do that plan.
Well, it's kind of like HIPAA training or OSHA training. We will have an OSHA trainer who comes in, and my staff's like, oh, well, we got to make sure we're doing this now and this here, and we don't want her to see this or that. And I was like, well, she's not the one that you're trying to get something by. She's the one who's here to advise you on what's going on, and seeing what you're really doing. Hey, you shouldn't do that, because the OSHA auditor is going to pick up on that. I think that's kind of your CPA. You're not trying to get something by you. You want you to have full transparency on what you see, so you can say, hey, Dr. Chacon, this is going to be a problem if they see it. We need to do this way, or X, Y, and Z, not, and take care of you in the kind of best possible way. I think that kind of goes back to, we're talking about, strategies for the end of the year. I keep hearing about 14-day rule, they said there's different tax changes. Are they tax changes this year, or deduction timing, or what should we be thinking about?
Yeah, so interesting, right? We don't want to get into politics, but really the politics will dictate the tax changes. So effective at the end of 2025, TCJA, or what's known as the Trump tax law, it fully expires. And you got a lot of options, right? They could extend everything. Nothing could extend, depending on who wins, right? So let's say you had a blue sweep in the fall. 2025, you're not locked into that law staying that law for the whole year. They could change it. If you had a full red sweep, that law could change. So even when we look at planning, unfortunately, we have to assume that the Trump tax law is going to stay all the way through the end of 25. But it's possible that it could change prior to that. Now, if we look at Congress and how inept they are, the chance of them doing anything until it runs out is almost impossible.
Sure.
But I do advise clients, hey, if we're making a big decision, right, are we selling the practice on 1/1 of 25, or are we selling the practice on 12/31 of 24? Right now, I'll tell you the capital gains rate is going to be 20% on both sides of that Rubicon. But I can't guarantee that, depending on, because 2025, it could change.
Depending on the outcome, you're saying.
Depending on the outcome, right? And if you end up with some version of divided government, then who knows how much of that changes. But I do think our traditional kind of bread and butter planning, when you're looking at like the Augusta rule, 14-day rental rule, and renting a home that you own to your business up to 14 days and being tax-free, that's something that documentation's key again, right? Making sure that whatever days that you're renting your home to your practice, you document what you did, whether it was a board meeting, a staff event. And then on top of that, the key of that is the fair market value. So if you live in a $100,000 home, it's probably not worth $2,000 a day to rent, right? So we always recommend look at the closest, nicest hotel or meeting space value.
Sure.
Find out what they rent it per day. And there was actually a big tax case this year that came out on the 14-day rental rule. And this couple, they had written off almost $300,000 over 2 to 3 years on the 14-day rental rule alone.
Wow.
And no documentation, Interesting, the court still gave them $600 a day for 14 days a year. They still owed a ton of tax and penalties and interest, but even with no documentation, they gave them $600 a day. Not sure why, but they did give them some credit for that. But they essentially had to pay tax penalties and interest on about $300,000. So just like everything within the tax law, the gray area comes in how you document it and do it. Everything's black and white, right? It's a rule, it's not a rule. But then how you implement that rule in your life and your practice depends on how great you document it and are you doing what you say. If you do what you say and you document it, there's a lot less gray in tax planning. And all of that kind of bread and butter, these items we're talking about, they're not really excessive tax planning unless you just write checks and don't do any of the documentation or really do what you're saying you're doing.
Okay, so let's pick an example. I want to buy a new milling machine and a scanner, and what else do I need?
Oven.
Oven. Of course, I need an oven.
Sure.
Okay, so it's going to cost me $150,000.
Sure. Yeah.
Jonathan, I want to do it.
Yep.
Talk me through that.
Yep. So first thing is, are you an S corp?
No.
Okay, not an S corp helps. But not vast majority of practices are S corp. So the first thing,
but I'm old, Jonathan. So I have a I don't have it any longer. A residual C corp.
So just backing up real quick, S corp versus a LLC operating as an S, or are these the same things?
They would be the same as long as you're operating as an S.
Okay.
But the first question I would ask, we would walk through that. Let's just say it makes sense for your practice, right? We're not just doing this for tax advantage. It makes sense for our practice.
I want to expand my offerings to be able to do crowns like Dr. Chacon does on the same day.
Yes. So are you borrowing the money or are you paying with cash?
What should I do?
Yeah. So if you're borrowing the money and you're an S corporation and you have no basis, so let's just imagine you're at zero basis. If you borrow $1 and you buy a piece of equipment for $1 and you write it off with first year depreciation, you actually don't get to take that in that current year because you used borrowed money in a corporation. You don't get basis in a corporation. I know that's kind of in the weeds we're talking about, but I think that's something that doctors miss all the time. They go and borrow $100,000, buy a $100,000 piece of equipment, and they could have basis, right, built up, money left in the business, bought out a partner. There can be things that cause basis, and they could write it off. But if, let's just say that's zero, and we're just looking at this piece of equipment, you can't write that piece of equipment off unless you put the cash in or you have basis in the business. And that's where I think a lot of the current year value in buying a piece of equipment where, the Patterson or the Shine guy comes in and says, hey, it's $150,000, you're going to save, 40% of that. Here's your real cost. The first question is, are you paying with cash? Great. If you're paying with cash, you're paying with earned money, then you're probably going to get to write that full thing off.
So when you say basis, if you have basis, then even if you're borrowing money, you can take it without basis. What exactly are you talking about with basis?
Yeah, so basis is kind of built up retained earnings. If you think about, let's say a company starts with zero and we earn $100,000 in profit, and you didn't take that $100,000 out in cash because you left it in the business. That $100,000 is there to buy the equipment. Then you still have basis because you haven't taken that money out. But if you earn $100,000 and you take all the money out as cash, that reduces your basis back to zero. Because it's kind of a basis unless, let's say you start a practice from scratch, is really your built up money or retained earnings in the business over time.
Does a typical practice have basis? So I've been doing it for 22 years.
Yeah.
Do I have basis in my practice?
Your basis would be more than likely pretty low because, if we were to,
because I don't manage my money worth of shit.
No, what I would say is most practices.
You just need better advice.
That's right.
Most practices don't have a large overhead requirement. So let's say your overhead requirement's $80,000. You're probably not going to leave much more than $80,000 in your practice in today's world because you can put that money to work somewhere else. So it would make sense to not have this massive amount of operating capital left inside of a business, especially in a one doctor S corp. And so, but that's the first question I ask.
Okay, so I go, yeah, Jonathan, I've got the money.
Yeah.
You go, is the money in the practice or is it in your wallet?
That's right. And
okay. So what's the difference there? Yeah.
So if you were to actually pay for it out of your wallet, you'd make a loan to the business and you could get basis for that because you're loaning the money in and you could actually take the deduction.
Okay.
So more and the cost segregation.
And you'd fair market value that loan to the business.
That's right. And you would pay yourself interest.
Right.
At least what they call the applicable federal rate, which is a minimum amount of interest you at least have to pay for kind of related party loans. So but here's the other thing. Cost segregation studies is one of the things you probably hear a lot about if you're buying your building or if you're doing a big build out. And that's essentially being able to take what is 39-year building property and writing it off much quicker. Same issue applies is, I have clients do big cost segregation studies, and sometimes it's on the leasehold improvements inside of an S corporation that was funded through a loan in the S corporation, which means they will get those deductions. They will get them quicker than they otherwise would, but they may not be able to write it all off as fast as they think. And trying to educate clients on basis and why they can't write off, hey, Jonathan, I just bought $200,000 equipment. I shouldn't owe any tax. Well, we need to go through about 3 other steps before we can verify that to be true. Harkening back to, if you have a big question like that, ask your CPA first, because you may be buying it thinking you're getting tax advantage, and turns out you didn't, and you're like, well, I shouldn't even have bought this equipment.
So here's my question. So let's say, just my real world example, I bought a $150,000 Cerac. I felt like by buying that in that year, we did pay less in taxes.
Yep.
Is my real world example. But I did borrow the money to do it, so I was still able to achieve a tax benefit, and I am an S corp. But I do feel like kind of what goes on. Let's say you have a 5-year note on it. All of a sudden, let's say your payment's $2,000 a month. I felt like what was starting to occur is that as you start paying that thing off, the $2,000 payment, even though your practice is making it, I was realizing that as income. So it wasn't it was no longer an expense for the practice except for the interest portion of it.
That's right.
And even though I wasn't taking let's say $1,500 of it as principal, I wasn't taking home the $1,500. I was getting dinged like I was taking home the $1,500. Is this what happens? Or
yeah, you actually hit the nail on the head better than I could have explained it. So really, what you're doing there is when you take accelerated depreciation, what you're doing is pulling forward a deduction. You're not creating a new deduction. And based upon time value of money, right? Sometimes it's better to take that tax deduction today, save the tax today, and then pay it essentially over time. But if you would have taken that 5-year note and depreciated that asset 5 years evenly, right, you would have been kind of mirroring that payment, that principal payment with the depreciation deduction. And they would have felt kind of one and one. But by taking that big number up front, say $100,000, when you're paying that $100,000 back to the bank, if we were able to use it in year one because we had other outside basis or inside basis, then in year 2, 3, and 4, you're paying that back with that after-tax money because you've already taken all that tax deduction.
So there's no free lunch.
There's not. And I'll tell you where you see it probably most pronounced is a startup loan or a practice purchase. In year 7, 8, and 9 or 10 of that practice payout loan,
it's a beating.
It is big. I mean, I've had a lot of hard conversations. I know we don't have cash, right? But I know we have to pay this tax because all the deductions got accelerated, and the principal portion of that big, $700-800 million loan is all coming in year 8, 9, and 10. And so those are squeeze years. I try to counsel clients in advance. Look, but when you tell somebody in year 3 there's pain coming in year 8, they don't remember about year 3. They just know about year 8. And so you try to explain it, and projections help, right? The one thing, and Dr. Chacon, I've given him a shock once or twice in his life, and I've heard about it, but nobody wants...
Dr. Chacon doesn't like that. Oh, no, I'm just telling you, I've known him a long time. He doesn't care for that.
But in general, you don't want to call a client on April 15th and say you owe $60,000, right? I mean, there's no planning involved in that usually, or now there can be misses. That's going to happen. People are imperfect, but you got to, that's that part of that projection and being ready for year end is planning that, because you'd mentioned, hey, I bought 150 in December. I go to my CPA in January and go, hey, I didn't make my payment in January because I bought this equipment. He may come back to you in April and say, well, that equipment actually didn't help you and you still owe that $60,000. And now you got penalties on it because you should have paid it in January.
So you need to read the whole book.
Yes.
Because you can't read the first chapter.
Well, ChatGPT today says you may be able to get around without it.
Well, no, but in terms of saying, calling your accountant and say, hey, I need to buy this equipment. I want to do it in December. Right? That's cool, right? And you got to read the whole story.
And you definitely can't just jump into it and just say, hey, Jonathan, I just bought this piece of equipment.
Yeah. Dr. Offit, you said, what questions do you want us to ask? It's the question before you commit resources to something like that. Yeah. And because you're going to always get a better answer. And that better answer could be quick. Like if Dr. Chacon calls me and says, hey, I'm going to buy this, will it help me? within probably 5 minutes of looking at his stuff, because I keep his accounting up to date, I know where his basis is at. I've probably ran a mid-year projection. I can give him a quick answer on that. But if you're a client who I don't have your information, that's a long process to get to the right answer.
Right.
And CPAs, we're typically risk averse, right? I'm super conservative when it comes to that, because I don't want to get sued giving, bad advice or erroneous advice. So CPAs are typically going to err on the conservative side.
Right.
Yeah.
Right.
You know,
That's the job.
well, that should be the job, right?
Right,
So,
right.
if you get the guy who tells you, he's going to save you a ton of taxes and you're never going to get caught, run. Unfortunately, with social media today, y'all probably see this a lot, even in your own dental kind of Facebook boards. There's a lot of tax advice going out there that is not by sophisticated people or anyone who has any training in it. It's like, hey, I got away with this, so you should do this.
Actually, Jonathan, that comes to a thing. I don't want to forget this. We would love for you to post some things for us to help our listeners and our viewers on our Facebook page, because it doesn't have to be tax law, just vignettes of things. I think we've talked about so many things.
Yeah.
I mean, Dr. Chacon gave me a list. We've talked about 2 of those things. Everything else we still are working on, but I
tell Jonathan,
awesome.
the first thing we got to do is get him on Facebook.
Yeah, it's funny. Dr. Khan, he emails me and he goes, "Hey, you got a Facebook?" And I was like, "It's about 15 years old and I've never posted on it." I was like, "So I probably need to set up something for the business." I'm only 47, but I live like I'm 77, so I got to get into the into the 21st century.
Get into this century.
Well, down the practice-wise, right, we're way forward in technology.
Right.
One of the things that I was going to mention is when you're talking about looking for a dental-specific CPA, and this is key inside of every dental practice, is where's the technology going inside that firm? If that firm is not, pushing forward in technology, you're going to be left behind as a client, because things are moving so fast in our industry, just like they're moving in your industry. Imagine if you didn't use the 3D scanners you have today compared to an old X-ray. Sure. So I think that is a real key when you're looking to work for someone.
Let's just back, talking about the technology and the changes. You sent me an email today about, and I didn't read it yet, but
he will
about something that you guys are doing now that is changing the reporting. Is that something, you can explain to our listeners a little bit, because it seems like you've always kind of been at the forefront of the best way to report information to your clients.
Yeah, and I think that's the key. About probably 6 or 7 years ago, when we started the practice, we were kind of legacy systems, right? You'd send us the stuff, we would write it up for you and send you back a piece of paper that. Here's where I found out clients never, ever looked at their stuff. So I used to, back in the day, I would bind it and put the bill in it. And I would call a doctor or two and say, "Hey, you're going to pay my bill? You're like 8 months behind." They're like, "Well, I don't ever open those." And I'm like, "Well, what am I doing spending all this time binding it?" So we kind of transitioned to more of a dashboard focus, right? Is like, I always tell clients, if you look at the first 5 pages or the first 2 pages, and those things are all going in the right direction, they're color-coded, then you're at least okay, right? And pay attention to those items, because I realize most doctors aren't going to dig in deep. But we do have more and more younger doctors who want to be entrepreneurs, who want to own 4 practices, who are growing, who are paying attention to the numbers, who want to know what EBITDA is. And as we're seeing that grow, we've invested in more technology. So we send out a kind of a dashboard that comes out of a system, but now the client themselves can get into that system and they can run their own P&Ls and run their own analytics based upon what we're pulling in there. And what's nice is it's not clunky like QuickBooks is. It's a much more interactive thing. And that's what, and we're finding just clients are two-sided, right? One, they either want to know everything or they never look at anything, right? And there's not a lot of in between, but the clients that want to look at everything are growing. And so we're trying to meet that need.
And those are the guys who, like you said, you run your own P&L. The last thing I'm going to do is run my own P&L. Are the guys running their own P&L the guys that are looking at acquiring 2, 3, 4 and are making their own projections out there, or what, who are those guys?
Yeah, it's a couple things, right? If you're looking to bring in a new partner, right? So if you're looking to bring in a new partner, a lot of times you want to grow the practice. There's a threshold before you bring in an associate or make an associate a partner. So maybe for that period in your life, you're really paying attention to those numbers and digging in. But definitely the guys and gals who want to grow 2 or 3 practices, they're paying attention to EBITDA. And then the people who are looking to, and we didn't touch on this, but DSOs. So that the last 2 to 3 years as you head to potentially sell to a DSO, if you know you're looking that far out, being in your numbers is more important than anything, because the sale is going to be a function of EBITDA times a multiple. So for every dollar of EBITDA, times that multiple, you just grow your value. So watching your expenses and growing revenue at a good pace, but also making profitability stick, because sometimes you can grow revenue and lose profitability, and that doesn't necessarily get you more enterprise value. So you want to be able to watch that EBITDA number in conjunction with what your multiple would be. So it's a variety of people that are looking at it, but you're right. Most people are not digging in on a month-to-month basis.
Yeah. So one thing I was thinking about when you start talking about DSOs is, kind of from a CPA perspective, dental specific CPA perspective, why should or shouldn't a doc look at selling that DSO? Where do you see the advantage? Where do you see you should be the guy looking at DSO, or you shouldn't be the guy looking at DSO?
Yeah, that's a somewhat of a loaded question, but it really depends. So there's not a hard and fast rule, but generally what I've seen, if you're within the last 2 to 3 years of practicing and you're maybe in a spot where it's not easy to sell your practice, we've seen this with some of the rural practices, or you don't really have a good succession plan. A DSO can be a good way to get, a good enterprise value up front with cash, work back for 2 to 3 years. The key there is finding someone that you're congruent with, that you can work with, that's going to treat your patients well. And then also looking at what that back end is. So there's no hard and fast rule. For me, though, young professionals in their early 40s, unless they're getting life-changing money, and that number is different for everyone, selling to a DSO doesn't make a lot of sense. Typically, within 5 to 7 years of working for the DSO, you've already earned back your practice for them through lower salary.
Sure, yeah.
And the roll forward money that they typically give you, I always count that as zero.
Mm-hmm.
So if a client calls me and says, "Hey, Jonathan, I'm going to sell my practice. I was going to wait 3 years, but I'm thinking about a DSO sale now, so I can work out my 3-year contract with them." First question we always ask is, if we're not working with you on financial planning, have you talked to your financial planner, and is the upfront cash going to be enough for you to retire? Because I would always count the rollover equity as zero in any financial plan, just to be more conservative, because we've seen PE hot and heavy in the last 4 and 5 years. I haven't seen any really pay off yet. Right?
Sure,
And
really.
that could happen.
Yeah.
But if I'm 62 and let's say I'm getting $5 million for my practice and $2 million's rollover, and I need that $2 million to retire, I would not factor that in. I would.
So you're not seeing that other 2 turn into 10,
Not yet.
like they're saying.
Yeah.
I mean, it's going to be a windfall, and now you are going to have a plane. Yeah.
And a lot of that rollover equity, and every deal is different, right? And there's experts and specialists in that's all they do every day. But a lot of that rollover equity, even when it's time to exercise it, you can't exercise all of it.
Sure.
So you may still be rolling over multiple times.
Sure. Well, Jonathan, thank you very much for spending some time with us today. It's been my pleasure to know you, work with you for, what has it been, 16, 17 years, something like that?
Long time.
Yeah. For our audience, what would you say kind of takeaway messages would be for them from kind of a CPA perspective? Is there any advice that you can give them, to simplify dentistry for them?
Yeah, I would say partner yourself with someone you like and trust, right? I think that's really important, and get into your numbers. At least get good quality numbers and pay attention to them a couple times a year. Make sure you understand where your overhead is, and so you can have a really profitable practice. And don't be afraid to ask questions, right? Dr. Offit mentioned, what question you want to hear. What we'd like to do is hear questions, because that interactive back and forth banter with clients always ends up with a best result for them and for the firm.
Yeah. Well, thank you all for joining the Simplified Dentistry podcast. Be sure to join our community by registering to receive future episodes of our podcast at simplifiedds.com. And please join our Facebook community, Simplified Dentistry. Dentistry is a hard profession. We hope that our community can help us all make it simple. Thank you very much.